I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast Show, and today is August 11th.
All right, we're here to give you some mortgage rate updates. What are they? And the inflation report came out yesterday. How did that impact mortgage rates? And the Fed predictions for the next 12 months, those predictions are always kind of interesting. So let's get into it.
And this is for informational purposes only. This is not financial advice. If you like what Tom and I are doing, be sure to subscribe, comment, and like. If you have a loan scenario for us you want us to look at or comment on, be sure to do that in the comments. Email us or call us. We are licensed right here in Phoenix, or in Arizona. That's where we're based right here.
Metropolitan Phoenix.
Yeah.
We serve the entire state.
That's right. And from the Mortgage News Daily, it's a survey of all the mortgage, or most of the mortgage companies in the country. They look at the rate sheets, and the average 30-year fix they see at 7.05. The 15-year fix they see at 6.42.
Yep, the FHA and the VA, I always look at those, they're almost identical. So 6.71 for FHA, 6.70 for VA.
And so they are up. You know, it's funny, like these things move around every single moment of every single trading day, but they're really up from the last couple weeks. And again, the reason has been one of the big reasons is inflation or talks of inflation and all the economy news. So just yesterday, August 10th, we saw inflation come in at 3.2%. That's year over year. So that is the July 2022 to July 2023. It's at 3.2%. The expectation, the forecast was 3.1. So slightly worse than they were thinking, but really close.
Yeah, from everything that we're reading, those numbers are basically mirror. Sometimes it's like 0.1. That's earth-shattering. But with some of the things we're reading today, it was almost felt like the same number. Yeah,
and then the core inflation, if everyone who's, starting to get familiar with what inflation is or how do they, what's in inflation, where that core inflation is the percentage of inflation without food or gas. And because food and gas can be so volatile, especially oil, for the gas, but food, if you take the food and gas out, inflation went down about 0.1, a little bit lower. So again, very flat, I would say. But again, the interest rates actually went up a little bit after this report. And it's really because, inflation may stay around a little bit longer. That's the fear.
Yeah, and what's interesting is when it comes to these numbers, computers are generating all these models, but there's still people that are having to translate it and people that are having to understand it. So it took a little while for that interest rate to bump up.
Yeah.
When it first came out, pretty much the same, and that bond stayed very, very level. And then all of a sudden during the day, it started ticking up.
So Truflation is a good alternative to look at the inflation number is the federal government is actually issuing that number. But Truflation is an independent private company that has about 10 million data points
10 million
every day that are reporting into their system. It's I think what they're doing is they're looking at credit card charges, or the Visa is telling them this is what the average spend is. Again, they have a whole workout. I may be misrepresenting that, but there's all these data points that it reads, and it's updating every day. Now, it seems to be leading the government's data. So when the U.S. government inflation was going up, Truflation showed that inflation peaked at around 12 to 13%. Now, again, this chart doesn't even go back. It was back in April of 2022 where it peaked. But now, as you can see, it thinks the Truflation is saying that inflation is at 2.37.
Yeah.
So lower.
Right, lower, which again, we want lower inflation, which is great. But Ed and I are talking, and it's like, hey, did you go to the grocery store? Did you get gas? Did you just, buy a little sandwich? What did it cost you? Sure doesn't feel like 2.37. So we don't know exactly what that means.
Yeah. Here's a good one for you. I mean, like if you go to Costco, if you go to Costco or Sam's Club, those big stores, we usually spend like a couple $100s per visit. Well, imagine $100 that you spent 1 year ago. Are you telling me that you only spend for the same goods only $3 more? That would be about 3%.
Well, yeah, in this case,
even less.
$2.37.
How is that possible?
Yeah.
Absolutely not. When I go to the store, and I'm sure you all would agree, it's like at least $10 to $20 more per 100 that I'm spending.
Yes, we figured out, well, are we just buying like the things that are the most expensive thing?
Yeah.
Like, hey, buy this. It's the most expensive thing. Everything else is like super cheap.
Yeah, I have no idea. And I mean, I'm scratching my head all the time when I hear 3% inflation. I don't know what they're talking about. Everything I buy seems to be going up. Anyway, share with us your thoughts on that in the comments as well. Okay, the 10-year yield. This is what really moves the mortgage market. It's what we look at all the time to see where mortgage rates have been and where they're going to be going. Now, again, the percentage this is the yield for the 10-year. So that's not so important as what the percentage is as the movement.
Right.
Okay, so the 10-year had a high in October of 2022, and that's when mortgage rates peaked. And then mortgage rates came down with that bond, the 10-year bond, down April 6, 2023. So that was the low, April 6.
Yeah, and as inflation was starting to get under control and people were starting to see and hear the little cracks in the economy, like, oh, that's great. It's pushing the bond down. Then all of a sudden, inflation's sticky. Oh, it's a little more stickier than we thought. And you can see it just start ratcheting up.
So August 3rd, just last week, we hit hit that resistance point. So it wasn't a high, but it was close to the all-time high, or not the all-time, just the recent high.
Yeah. And again, the reason for that is inflation was sticky during those quarters. And then also when it hit that high, it's like, oh no, maybe we're keeping interest rates higher for longer.
Mm-hmm.
So that's ultimately that higher for longer is what drove it to that next peak. We keep thinking, okay, we're done with the peaks.
Yeah, we're still, we keep on thinking that it's not going to go up higher. Now, again, this red bar here is resistance. It has to get through here. It means there's a lot of sellers here. We'll probably be shorting the 10-year bond as we don't think that rates will get really above or really, really close, we believe, to the high, but it could go higher. But again, if it moves down, it has to go through these support zones right here. And we'll be tracking that. So be sure to follow us regarding that.
Okay, this is one of my favorite matrices of all time.
Yeah, so the CME, the Chicago Mercantile Exchange, reports this is the probability table. And it shows the next meeting for the Fed is September 20th. We are at 5.5% today on the Fed rate.
Right, and that was updated just...
last week?
Last week.
Or no, yeah, I'm sorry.
Week and a half ago.
Yeah, week and a half ago, yeah. So in July, I think it was July 26th. Okay, so next meeting is
September 20th.
September 20th. So we have, a little over a month, maybe almost a month and a half away. There's a 90% chance that rates are not going to do anything.
So this is like sitting in a room full of like poker players or I don't know, people in Vegas. And they're like, hey, what do you think? Do you think the rates are going to go up or go down? So right now we're saying 90% of all those people that are betting are saying, no, it's not going to move in September. It's not going to move in November. It's not going to move in December. That's what these people are saying.
They think that it's maybe has a chance in January of moving down a quarter. There's a 29% chance it'll move down. But look, there's a 15% chance it'll move up a quarter. But it really isn't until about March of 2024. Again, this thing updates every day. We have been tracking it. As if you've been following the channel, you will notice that we've been tracking this, and it seems to be it's pushing out further and further into 2024. Meaning we were seeing this curve where rates were going to come lower in the fall. And, fall of 2023, but now they're pushed out really into the spring of 2024. I think what we try to do too is how does the Fed rate correlate with mortgage rates? Well, this isn't an exact science, but if you just look at the differential between the two and take it down through through December 2024, what does it look like? If we have the expected rate today, which is at 5.5, and then the mortgage rate, let's just say, is at 6.99. We could see at the end of 2024, if the Fed rates are like 3.75, then maybe the mortgage rate's at 5.24.
So basically the takeaway here is the mortgage rates are about 1.5 or 1.5% higher than what the Fed funds rate is. It's not exact science, but that's just what we're saying.
We'll be sure to monitor this. So be sure to subscribe, comment, and like. Give us a call if you have a scenario you want us to take a look at. And I hope everyone has a great day.
All right. Thank you, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.